Good day to you, Murray Gunn here, and today I'm looking at the European Union. Now it might seem difficult to believe, but Europe has been in a bear market for 20 years because the broad Eurostoxx index high from back then has still not been exceeded. And the negative social mood trend that is driving this bear market could now be entering another intensive phase. Let me take 2 minutes of your time to guide you through an interesting socioeconomic development and what it means.
75 years ago this week, on the 7th and 8th of May 1945, Nazi Germany unconditionally surrendered to the Allied forces, so ending the brutal 6-year-long European theatre of World War II. After the trauma, the following years concentrated on the rebirth of Germany. As part of that rebirth, in 1951, Das Bundesverfassungsgericht, the German Federal Constitutional Court, was officially opened, its main aim being to protect the German constitution and prevent anyone like the Nazis ever taking over again. It is highly respected in Germany for this very reason. This week, the German court created headlines because it is questioning whether the European Central Bank has overstepped its mandate in its bond buying programme. It has threatened to block further purchases unless the German government can prove otherwise, potentially putting a brake on the ECB's response to the current economic crisis. In doing this, the court is essentially fulfilling its role in seeking to protect German taxpayers from potential losses. Also fearful of any return to the money printing induced hyperinflation of the 1920s in Germany that played a big part in the Nazi doctrine becoming popular in the first place. Should the situation develop into a standoff between Germany and the ECB, it will be consistent with the 20-year negative trend in European social mood and could threaten the entire European project. A useful way of measuring the strength of the European Union is to look at the yield spread between France and Germany. The Franco-German alliance is the glue that binds the entire project together, and so any divergence between the two nations will show up in this spread. The yield spread has been very stable over the past few years, fluctuating in a relatively tight range, French bonds yielding between 0.2 and 0.5% over German bonds. However, over the past couple of months, the yield spread has spiked higher as the negative trend in social mood caused stock markets to crash and questions over European unity to emerge. Given that we expect the negative mood trend to continue, we are anticipating that this yield spread will rise further, indicating increasing fragility in European Union unity.
The next couple of years will either make or break the European Union. You can stay ahead of the drama with EWI's European Financial Forecast Service.